Welcome to The Deep Dive. We're Talk Tickers, and we are here to cut through all the noise of corporate earnings calls to give you the insights that actually matter.
And fast.
And fast. Today, we are cracking open the Q3 2025 results for ZTO Express. Now, if you follow the logistics space, you know this one was a bit messy right out of the gate.
Oh, yeah. We saw that initial pop on the headline numbers, but then the trading got really choppy as people started digging in.
Exactly. There are these huge counter forces at play here, so we're framing our whole deep dive today as, let's say, cautiously constructive.
Cautious is definitely the right word. I mean, this quarter is a perfect case study in that tension between your own internal discipline and just brutal external pressure.
So to understand that market whiplash, you really have to look at the top and bottom lines, almost like they're telling two completely different stories.
They really are.
Okay, so let's start with the good news, the part that drove that initial spike, the profitability beat.
Yeah, the bottom line.
Adjusted EPS landed at RMB 3.06. I mean, that just blew past what everyone was expecting. Consensus was around, what, RMB 2.51, 2.52?
Yeah, so we're talking a 20 to 25% beat. It's huge, and it's all about cost control.
Purely managing the expense line. But of course, there's a but. The top line. That told a very different story.
A much more challenging story. Revenue came in at about 11.86 billion RMB. The street was looking for something closer to 11.91 billion.
So a slight miss, but a miss nonetheless.
A miss is a miss, and it just confirms that the volume and pricing environment is, it's still really tough out there, even for the market leader.
Okay, so let's get into the mechanics of that. What's happening with volume and pricing?
Well, parcel volume grew 9.8% year over year. That's 9.57 billion parcels. It's solid, but you can see it's decelerating a little.
And the pricing.
The average selling price, the ASP, for their main express business was only up 1.7%.
That's tiny.
It is. And what's really interesting is why it was even up at all. Management said they're pushing heavier incentives and the average parcel weight is getting lighter. Both of those things should push ASP down.
So how did they manage an increase then?
They offset all of that with an 18 fen, so an RMB 0.18 increase in their key account unit prices.
So they're getting better pricing from their big, important customers.
Exactly. It suggests that while the price war is just raging at the low end of the market, they're actually winning the battle for that higher margin business.
Okay, this is the core of it then. This is the tension we need to unpack. How does a company deliver this incredible EPS beat while at the same time their margins are getting absolutely crushed?
Yeah, and when we say crushed, we mean it. This isn't some subtle squeeze. Gross profit was down 11.4% year over year.
Wow.
And the gross margin itself, it fell by 6.3 percentage points. It's now sitting at 24.9%.
6.3, that is a huge drop.
It's massive. And they were very direct about it. They linked it straight to the price war and some negative mix shifts.
And you have to think, if ZTO, the biggest player with all that scale, is seeing a drop like that, what does that mean for the smaller guys?
It means they're getting wiped out. It's a shakeout. Even ZTO's adjusted EBITDA was down over 4%. So this is hitting their core profitability hard.
Which brings us back to the main question. With that kind of margin pain, how in the world did they pull off that EPS beat? It has to be all on the cost side.
100%. It's what we're calling the efficiency offset. This is the whole bull case for their long-term moat.
Right.
Management pointed out that their combined unit sorting and transportation cost per parcel went down by RMB 0.05. 5 fen.
Wait, hold on. Let's make that real. 5 fen per parcel. They moved 9.57 billion parcels. So you're talking, what, nearly 480 million RMB in savings.
Exactly.
Just from internal cost cutting.
Yeah.
In one quarter.
That's the entire difference between a huge earnings miss and the massive beat they delivered. That's the power of their scale.
And they're keeping a lid on fixed costs, too.
Yep. SG&A expenses were stable as a percentage of revenue, holding at 5.3%. Okay. They're not letting overhead creep up and eat away at those operational wins.
And this isn't just like a one-time belt tightening, right? They're investing to make this permanent.
That's the key. They talked about ongoing investments in automation, in digitization across all their hubs. This is structural.
Which explains the huge CapEx number they threw out.
Right. They're projecting 5.5 to 6 billion RMB in annual CapEx. That's what it costs to constantly upgrade your engine to be faster and cheaper than everybody else.
And having that discipline, that efficiency, gives them the room to make this big strategic shift that the CEO, Mason Lai, kept talking about.
The move from volume at any price
To quantity plus quality. This feels like the most important part of the call strategically.
It is. It's a huge pivot for a company that was built on just sheer scale.
Yeah.
And it's not happening in a vacuum. The regulators are basically enabling it.
Right, the anti-involution policies. Right. Can you just break that down for people who might not be familiar with the term?
Sure. Think of involution as a race to the bottom. Just pointless, self-defeating competition where everyone is cutting prices, destroying profits, making working conditions worse, all for a tiny bit of market share.
So anti-involution is the government stepping in and saying, enough, compete rationally.
That's it exactly. Management sees it as the government creating a pricing floor, especially to protect what they call grassroots interests. So the couriers, the network partners. It's the catalyst that could finally lead to margin repair for the whole industry.
But that feels risky, doesn't it? Betting your entire long-term story on government policy being enforced consistently, that introduces a whole new kind of risk.
That is the big debate. It's a huge risk. But ZTO's argument is that since the policy goals line up with what they want to do anyway, focus on quality, they're best positioned to benefit.
And we're seeing proof of that pivot in the numbers.
We are. Look at their non-e-commerce business. We're talking B2B, offline retail parcels. And that segment grew by almost 50% year over year.
50%? Wow.
So they're successfully diversifying away from just being a low-margin e-commerce delivery company. They're building a real, comprehensive logistics platform.
And it all ties back to protecting the network partners and the couriers, which is central to that whole anti-involution idea.
Absolutely. They spent a lot of time in the Q&A talking about their consultations with government agencies. They don't see it as a threat. They see it as a stress test to make sure the network is fair for everyone.
Okay, so we've got this amazing cost control story and a strategic pivot supported by regulators. Now we have to talk about the other shoe that dropped.
The thing that cooled the market off right away.
The cut to forward guidance.
This was the major headwind. They officially cut their 2025 parcel volume guidance. It's now down to a range of 38.2 to 38.7 billion parcels.
Which is down from, what was it before?
The prior range was up to 40.1 billion, so it's a noticeable cut. It now implies growth of around 12 to 14% year over year.
And how did management spin that?
They framed it as a good thing. They said it aligns with more rational, high-quality industry growth. In other words, they're deliberately choosing not to chase every last low-margin parcel.
So the slowdown is a direct consequence of raising prices to comply with the new regulatory reality.
That's the narrative, yes. Those price increases hit the most price-sensitive e-commerce merchants first. They think the industry growth will probably settle in around a more sustainable 10% next year.
Okay, stepping back. That guidance cut, plus the margin pressure, it explains a lot about the stock's performance over the last year.
It really does. The numbers are pretty stark. ZTO's one-year return was negative 3%.
Negative 3.
At the same time, you look at a broad China equity benchmark like the MCHI ETF, that was up around 30%.
So a 33 percentage point gap, that's a massive underperformance.
It is. It tells you the market is just not buying the recovery story yet. There's still a lot of concern about whether these price wars are truly over, even with ZTO holding almost 20% of the market.
So the whole long-term pitch is basically trust our cost savings, trust that the regulators will hold the line, and eventually the market will have to reward us for it.
That's the hope. But the market remains unconvinced, which brings us to how some people might be looking to play this mismatch.
Right. So given this huge disconnect, proven efficiency on one side, major regulatory risk on the other, what are the smart money conversations happening right now?
Well, before we get into any ideas, we have to say the obvious. This is not financial advice. We are just exploring a hypothesis for educational purposes. We are not recommending anyone do anything.
Disclaimer noted.
Okay, so given that deep pessimism we just talked about, the fact that ZTO has already been punished for all this uncertainty, you see an opening for a kind of outrageous but plausible relative value play.
I'm listening. Lay it on me.
The idea would be to initiate a long position as ZTO, but pair it with a short position against the broader China equity index, say using the MCHI ETF.
Okay, interesting. So you're hedging out the general China risk. Why do that when ZTO is a China growth story? It seems a bit counterintuitive.
It does, but it's a very specific bet on decoupling. See, the market is pricing ZTO like it's just a geared play on the Chinese economy, plus all its industry-specific problems.
Right.
By shorting MCHI, you effectively neutralize that general China macro risk. You're no longer betting on property developers or geopolitics. You're left with a pure bet on ZTO's own specific advantages.
The things that MCHI doesn't have.
Exactly. You're betting on that government anti-involution policy, creating a real pricing floor, which MCHI doesn't benefit from. And you're betting on that proven cost discipline, that RMB 0.05 per parcel saving, which is totally unique to ZTO.
So the catalyst is just proof. If they can show that the cost savings stick and the regulatory floor holds, their value should pop relative to the index no matter what the broader Chinese economy is doing.
That's the thesis. And the check is pretty simple. If we see margins stabilize in the Q4 peak season, and if they can still hit that mid-teens volume growth, that valuation gap between ZTO and MCHI should close, and close fast.
A fascinating deep dive. So the core takeaway is this very dual-sided story. You have a profitability beat that's driven entirely by just incredible scale-driven cost control.
But that's being overshadowed by the margin compression and a lower guidance, all thanks to these new regulatory floors they're navigating.
It's cost control versus the regulators, really.
Which leads me to one last provocative thought for you to chew on. ZTO is spending a fortune 5.5 to 6 billion RMB a year on CapEx for automation and last-mile build-out.
Right.
So the question is, will that huge investment translate into a competitive advantage that's actually strong enough to close that massive 30-point valuation gap we talked about? Or is it just defensive spending to stay in the game?
That is the multi-billion-dollar question, and answering it will be the key to the stock's future. Thanks for joining us on this deep dive. We encourage you to dig into the materials yourself.